So, can a stronger dollar actually buy more gold? There's a long answer and there's a short answer. You want the long one, right? So, one of the ideas that comes up over and over is that the price of gold is not reflective of its actual value. And that's probably true. But people reference the spike in money supply, they reference availability, and they reference manipulation. But not very many people point out the simple fact that it's off, and it's probably off a pretty significant amount, simply because of the US dollar index. So, in a roundabout way, you could actually say that a stronger dollar lets you buy more gold. But maybe not in the way that you think. So in this one, we're going to take a look at how significant that might be. And we're not going to use hype around the topic here. We have enough people giving opinions on why gold should be at $10,000 an ounce or above. But at the end of the day, that is just an opinion. It's not a very useful one. We've been hearing it since 2020. Really haven't been able to do anything with it at all. So we're going to look instead at a realistic number based only on the actual performance of the dollar to give us some insight on if we really do see a discount in US dollars and what that means for the near-term price of gold. So first off, we need to look at the actual reason that this happens. We hear about the DXY, that's the dollar index, and its effect on gold a fair amount, but only in general terms. Now, the correlation is rarely explained, and when it is, well, it's usually wrong. I've seen people explain that because gold is dollar denominated, its price goes up or down in direct correlation to the DXY, as if it's the market price of seafood on the menu, or that a stronger dollar can simply buy more gold. It seems straightforward, but it really isn't true. We need to step back just a little bit and look at defensive assets. Now, the majority of the people watching this video probably don't think of the dollar as a defensive asset. You might even be saving a bunch of cash for one reason or another, but it's probably not as an investment. Well, to get to the point here, even if you don't see it as an investment, there are a lot of people and institutions who do. So if you think through the big asset classes, you have equities, treasury bills and bonds, cash, real estate, gold. Those are probably the big ones. You can throw in others if you like, crypto, cars, art, whatever. But if we focus in on the defensive assets, you have really three. You have cash, treasuries, and gold. Don't let that part throw you off, though. Maybe you consider real estate to be a defensive asset. I know that I do in general, but not at all like cash, bonds, and gold. They operate differently with a much lower correlation to recession pressure than real estate does. They're also much less prone to a crash. If you look at what real estate is doing right now, the prices are going down. It's more of a growth asset, and it's not performing very well at the moment. Starting with cash, the DXY is hanging out at 20-year highs right now. What that means is that compared to other currencies, the US dollar is stronger than it's been in 20 years. You can pick whatever analogy you like, best horse in the glue factory works, but large investors and institutions are still putting their money into US dollars as a safe haven because it's a defensive play against other investments that just are not doing well right now. So where you might normally see investors rotating capital into gold, they're rotating it into US dollars, or they're just staying there. So we see less demand for gold. Now, the second factor here, it's a little bit more direct. It's that because gold is US dollar denominated, it's more expensive to buy it with other currencies. And because of that, it just becomes harder for foreign investors to preserve capital by buying gold since gold is inflated based on the current currency exchange rate. So there again, that means less demand for gold. Neither of those factors directly change the price of gold. They actually lead to lower demand, higher selling pressure, and then that creates the supply and demand paradigm that we all know about. Fewer people want it, so the price goes down. Usually. So the other big one here we're just going to touch on briefly is that with high inflation and high interest rates here in the United States, the returns on Treasury securities have gone way up as well. These are seen as easy money since they're guaranteed by the US Treasury, and in the case of I-bonds, the final rate is actually based on CPI. So you have a literal inflation hedge. So on top of it being easy money, the current rate on an I-bond is the highest it's been in more than 20 years. It's at 9.62% right now. So it's no surprise to think that money is going to be flooding into treasury programs where previously it might have been rotating into gold. Now, this is not a video about whether treasury programs are good or bad, so we're not going to get into further details. This is simply a look at another factor that's affecting gold's current price. So we've covered the dollar, we've covered treasury securities, and since we're talking about defensive assets, that of course brings us back to gold. So right now, the price of gold is somewhere around $1,750. Now this is on the verge of Jerome Powell speaking at the Jackson Hole Symposium, so that won't stick around long. But at $1,750, the big question is how much that price is being pressed down by the comparative strength of the dollar and the unusually strong bond returns. So Kitco had an article recently citing John LaForge from Wells Fargo saying that he thinks the impact of the US dollar is decreasing the current price of gold by $150. I don't have the details of the calculation, but given the way that gold price has been moving counter to the DXY, that seems pretty feasible. So we aren't saying that gold should be $10,000 and then walking away. We're looking at something more like $1,900. That would be the current estimate for where gold would be if we didn't have an unusually high dollar index. Now, Wells Fargo Investment Institute still has their price target for gold set at $2,000 to $2,100 by the end of the year. And even if that seems like a stretch, well, understanding the reason for that target is still useful. And so is understanding what might happen to the price of gold relative to the strength of the US dollar going forward. If the DXY starts to come back down, which is likely, then the price of gold becomes cheaper in other currencies. So the value of the dollar as a safe haven gets a little sketchier, and the demand for gold goes up. That's not a hard rule, it's just common sense and historical performance at work here. So what do we walk away with? If the DXY began to balance back out, which is exactly what a lot of analysts are saying will happen beginning in Q1 of 2023, well then the likely case is that we would see a jump of that $150 that John LaForge mentioned. That puts the price of gold at $1,900. Their target is still higher than that. So Wells Fargo is assuming that we'll continue to see other negative factors in the economy. All of that is future forecasting. It's all guesswork. That $150 though, that's more a matter of what's happening right now based on the strange performance of the dollar. So if you're wondering which direction the price of gold is going over the near term, don't forget that while the price of gold has been going down, the DXY has been going up, and that's having an atypical impact on the traditional favorite defensive asset, gold. Okay, so let's call it good there. Let us know if you have any thoughts on gold price, either by the end of the year or early next. I mean, maybe it doesn't even affect what you're up to at all. Let us know. And then while you're in the comments, be sure to hit the like button if you found any of this interesting. Make sure you're subscribed with notifications turned on if you want to see more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.